Good afternoon. My name is Ed Papier. I've been a wealth advisor since 1986 and specialize in retirement and investment planning. Welcome to the good, the bad, and the ugly. Alternative investments, RMDs, and annuities. A discussion of some topics I frequently get asked about. It's all related to what to do in today's chaotic and overvalued investment markets. We'll cover the good, which are alternative investments, and why investors are increasingly attracted to them. The bad, which are the RMDs, or required minimum distributions from IRAs, and the ugly, those vehicles everyone loves to hate, annuities. Let's work our way backwards with the ugly first. Most folks believe annuities are the worst investment you can make, but they actually have an interesting purpose. Probably the best investment vehicle to compare them would be a bank CD. With a CD, a bank credits you with a guaranteed rate for a fixed period. It could be 6 months, a year, 3 years, or longer. The CD grows each month, and interest gets credited to your account. As you're aware, if you surrender the CD early, you pay a penalty. One of the problems with the CD is that every year you get a 1099 for the CD's growth, since the bank is required to report the accrued interest even though it isn't paid out. This is a form of what's sometimes called phantom income, and is analogous to what mutual funds do when they distribute capital gains you have to pay taxes on, even though you haven't taken any money out of the mutual fund. So how does a CD compare to an annuity? An annuity is a series of equal payments made typically over a set period of time or for the rest of a person's life. If you think about it, Social Security is a form of annuity. The only problem with Social Security is that the U.S. government is so indebted it has to find ways to raise revenue and reduce the debt. So future reductions in Social Security could occur. Company-sponsored private annuities like defined benefit or cash balance plans will pay lifetime income. However, these are fewer and far between these days. And of course, there are the traditional commercial annuities, which are contracts written with an insurance company. There are three common types of annuities: fixed, indexed, and variable. Your investment can be allocated to either safe investments, which are the fixed and indexed choices, or riskier market investments, the variable choices. You can hold the annuity inside or outside of a qualified plan. It could be held in an IRA, a Roth IRA, or it could just be a regular taxable account, sometimes called non-qualified money. Regardless of where it's held, the assets in the annuity are going to grow tax-deferred, whether it's in an IRA or after-tax money. It'll also be tax-free if it's held in a Roth IRA. Unlike a CD, you won't get a 1099 until you actually start withdrawing funds. How much the annuity grows is based on what type of annuity you've selected. A brilliant observation made by an associate of mine is that when it comes time to take the money out of an annuity, the one thing an annuity can do that nothing else can do is that when the contract runs out of money, the annuity doesn't run out of income. This is a very important observation. Remember, the one thing you need in order to retire is to have a paycheck, as if you were still working. And what you really need is a paycheck that won't run out. Now, as mentioned, there are three types of annuities. Here we see how they behave. Variable annuities sit in the riskier bucket because they participate in most of the gains of the market. But they also participate in all the losses of the market. You get the market's gains and losses, so you're participating in the market's volatility. Some folks consider investing in variable annuities to be a very tax inefficient investment because you're essentially converting what would have been capital gains by investing in the market in a taxable brokerage account into higher ordinary income rates in an annuity. Think about it. If you invest in a mutual fund and hold it for more than a year, you're taxed at capital gains rates at 15%. If you buy the same mutual fund in an annuity, whenever you take your gains out, you pay tax at your highest marginal bracket, which could be in the 30s. Why would we do that? I'd agree it doesn't make much sense. A fixed annuity is much like a bank CD. That'll give you a guaranteed fixed rate of return. It's the most conservative investment choice in an annuity. that's going to be a very small rate compared to other ways you can grow your money. It's going to be very similar to a CD, although it'll have higher returns than a CD, and it's going to be tax deferred if it's non-qualified. It grows based on what the fixed interest rate is. These contracts have very few bells and whistles. Most people don't use fixed annuities unless they're just trying to grow their money safely for a short period of time. Then there is an indexed annuity. They're called fixed indexed annuities because they're not subject to the market. They're in the safe bucket as well. But even though they're in the safe bucket, they actually will rise when the market goes up. But as you can see, when the market goes down, they go sideways. So we never participate in the losses of the market. But importantly, when the market makes a huge gain, you don't participate in all those gains either. You get reasonable gains but no losses. And you've probably experienced, with the markets being so volatile, going up and down with frequency, that's something that makes folks very uncomfortable. So with the index annuity, as the market goes up and down, we take a nice leisurely ride up without the downside volatility of the market. These contracts have various features called floors, caps, participation rates, and spreads. These all determine how much of the market's upside you participate in, which determines the growth rate of your annuity. For folks looking at these contracts for the first time, it may seem a little confusing, but it's really not that confusing if it's explained to you properly. With all that said, the likelihood is that over a longer period of time, say 10 years or longer, you're likely going to get a rate of return somewhere in the 3 to 7% range from all of these contracts, no matter what the marketing folks tell you. But here's the important point to reiterate. There are other things going on inside an annuity that will sustain the income, even when the contract runs out of money. Another important thing to remember about annuities is there's a liquidity provision inside the contract. And typically, with almost all annuities, that's equal to 10%. So after the first year, you can access 10% of the value once a year if you need the funds. And you can do that every year. So they're more liquid than a CD. And remember, with a CD, if you take money out, you're going to get penalized. But inside of the annuity, you've got this 10% free withdrawal provision. As you're aware, annuities are backed by large insurance companies. And it's important to understand that insurance companies are the financial backbone of the world's monetary system. In fact, during the Depression in the 1930s, while all of the banks were going bankrupt, the insurance companies stayed solvent. That was possible because the insurance agents back then collected the premium from the insured personally via what was called a debit run. They went house to house and collected a nickel every month. Those nickels added up and kept the insurance companies solvent. The main point to remember is that when annuity is turned on for income, when the contract runs out of money, it never runs out of income. Let's look at an example. This client is 65 and his spouse is 64. They're in a 25% marginal bracket. Here we put $500,000 in an annuity. And then I took an illustrated rate based on the last 10 years of market return data. So we can see how the market's return influenced the annuity's growth. And then I determined what the payout would be. That's here in the withdrawal column. As you can see, it started off at $36,229. And then it started to grow based on the return from the market. Remember, we get credited with 0 when the market is negative. Every time there's a crediting calculation, the payout rate increases. So I went from $36,229 to $51,909 by age 83. As I keep making withdrawals, the contract is eventually going to run out of money here at age 83. We see there's no money left in the contract, but our income keeps coming for as long as you live. In this annuity, the income stays level. There are a few annuities out there that actually increase after they run out of money and keep going up over time. So to reiterate, the key takeaway in this example is that when the annuity runs out of money, it doesn't run out of income. Now, let's remember those numbers and look at a brokerage account, with the same exact amount of money, $500,000, and the same withdrawal amounts. Let's use a 6% average rate of growth. That's a reasonable rate given the fact the market can go down 10 to 20% every now and then. Ask yourself, do you think there's a chance there could be a year or two or three where the market goes down 10 to 20% during your retirement years? If so, then a 6% average is reasonable. Let's take a point off for expenses, so we're netting 5%. Now let's take the exact same drawdown rate starting at $36,229, aiming for $51,509. You can see here the brokerage account runs out of money at age 91 and 90. But when this account runs out of money, it runs out of income. No more paycheck, no more lifetime income, at a time when you may need it most for the cost of long-term care, for example. I read an article the other day. There are now more people living past age 100 than ever before. And guess what? That's the age when you'll need funds to pay for the cost of care. So one of the most important takeaways of this video is that when you retire, you need a paycheck. And without a paycheck, you're not retiring. So investing in annuity is like going out and buying a pension plan. There's nothing exciting about these annuities. They're not making huge rates of return. They're not going to grow your money at huge rates like venture capital in the alternative investment space. But what they will do is provide a guaranteed stream of income that you can never outlive. Once you've got that guaranteed income coming in, we can take the balance of your assets and invest not only in other income-producing investments, but riskier investments as well if you like. And if you lose it, it's not as important because we still have the income stream. Let's now take a small look into the world of alternative investments to complement your investment in the safe bucket, where you may have decided to guarantee your paycheck with an annuity. Remember our good, bad, and ugly? Well, here's the good. For those of you interested in learning more about this topic, please go to my website, www.amadeuswealth.com. Parenthetically, if anyone's interested, I named the firm in tribute to Mozart, the famous composer, because I'm an amateur classical pianist. There you'll find an article on alternative investments. Take a minute for the video to populate. There we go. You can find it located under the Resources tab on the website. The article contains a discussion of many of the alternative investment asset classes, like private equity, private credit, real estate, and many others. One of the categories mentioned there is mortgage REITs, or real estate investment trusts. This particular one is a debt fund specializing in the origination, financing, and placement of short-term loans across a variety of real estate asset classes, including multifamily, skilled nursing, and assisted living facilities. Here are the actual returns of the REIT. I'm not necessarily suggesting this investment is appropriate for your portfolio, but I wanted you to be aware of the kinds of returns available in the alternative investment space. This fund essentially makes private mortgages. You can conceive of this investment as an alternative to the bond market. The income you earn from the REIT is only subject to 80% with respect to taxes. 20% of it is tax-free. So there's clearly a tax advantage. Even more so if you hold the investment in an IRA, if you can find a custodian willing to custody the asset, or if you have a self-directed IRA. The current 10-year Treasury sits around 4%. Contrast that with the 12.5% return of this REIT. Keep in mind, however, that unlike the regular bond market, alternative investments have a degree of illiquidity. With this investment, you have to lock your money up for a year before you have the ability to ask for it back if you need it. Below the return chart are common lengths of illiquidity for alternative investments. At the end of the article on alternatives on the Amadeus site, there's a glossary of terms with which you might want to become familiar. One that's mentioned is something called the illiquidity premium, which basically says the longer you can afford to tie up your investments, the greater the probability of achieving higher returns. There are many other important concepts described there, and it would be important to familiarize yourself with them should you wish to start to tackle the learning curve associated with alternative investments. Let's talk a little bit about the different ways the stock market can be valued. There are various ratios like price to book and price to sales. The most common and well known is price to earnings, the PE ratio. It's such an important ratio that it's been studied in academia. A famous economist at Yale University named Robert Shiller won a Nobel Prize for his work with the PE ratio. In fact, they even named it after him, the Shiller PE. Today it's been hovering around 40. Let me focus on that number by analogy. Let's say there's an ice cream store in your neighborhood that you've been going to for years and years. You took your kids and grandkids there, and one day you're walking by and you see a for sale sign in the window. So you go in and ask the owner what's up, and he says that he's decided to retire. He's getting older, wants to sell the business. And you say, funny thing, my son's been looking for a small business to buy. Would you mind my asking what you're asking for the business? And he says, $4 million. And you say, well, that's a lot of money. How much revenue are you earning? And he proudly says, $100,000. Now, would anybody in the audience today pay $4 million for a business that's generating $100,000 of revenue? I suspect not. But let's look at it in these terms. The discussion of the ice cream store leads me to my final topic, our bad from the good, bad, and ugly. As many of you know, RMDs are required beginning at age 73. If you didn't make Roth conversions between the ages of 60 and 73 by taking IRA withdrawals up to the top of your marginal tax bracket without flipping into the next higher bracket, which is a strategy a lot of people use, and you've accumulated a significant IRA, you'll be forced into taking distributions, generating a lot of taxable income. When retiring, when folks often roll their 401k into an IRA, many investors don't change their asset allocation. They've been invested in the stock market, and the IRA remains similarly allocated. They leave their allocation in a market that today costs $40 for every $1 of earnings, a la Shiller PE, which is analogous to paying $4 million for an ice cream store that generates $100,000 of revenue. Investors often fail to make a transition from growth to an income-oriented portfolio. Of course, an allocation to growth makes sense during the accumulation phase, but while you're still working and funding the 401k. But the distribution phase has thrown us a curveball, which is the RMD. By failing to transition from growth to income, we end up with what I call IFCOME, meaning if the stock market does well, you'll have sustainable income. I recall a mentor who once said, the value of a portfolio is not in the amount of assets it holds. Rather, it's in the amount of sustainable income it can produce. Let's look at an example. Here's an individual with $1 million in her IRA who had to start her RMDs in the year 2000, the height of the dot-com bubble, the worst time to start withdrawals. 10 years later, there's $554,000 left in the IRA. Now, why did that occur? Because of these 4 bad years. Suffice to say, had this investor purchased an annuity in her IRA in 2000, she would have been much better off. We can see this concept illustrated in another way. Here's a $1 million portfolio with no withdrawals. In the first return sequence, the light green at the top, it earns 25% the first year, 10% the second, and negative 15% the third. The ending balance is $1,168,750. In the second return sequence, the dark green on the bottom, the returns are reversed. The negative 15% is in the first year, then 10, and then 25. The final balance is the same, so it doesn't matter in what order the returns occurred. In this second sequence, we withdraw $100,000 each year. The same set of returns occur. In the first set, the ending balance is $890,250. However, this time, when the negative return is in the first year, the ending balance is $806,250, or about $85,000 less, which raises the question, and I asked it previously, does anyone think the market could lose 15% in the early years of their RMD? If so, given these observations about return sequences, you may want to reevaluate your asset allocation, something we can help you with should you have interest. So to summarize, we've reviewed the good, alternative investments as an asset class. Then there's the bad, the dreaded RMD, which we've just barely touched on. On this topic, please be aware there are a couple of ways to reduce the RMD, which can be a topic for another day. And finally, there's what many believe to be the ugly, which are the annuities. I hope you've concluded from today's presentation they're not as bad as mainstream media wants you to believe. If you've got assets in or out of an IRA, you may want to consider taking a portion of it and investing in an annuity. If you do that, you'll get a guaranteed paycheck for the rest of your life. You can then take the balance of your assets and invest in the market, as well as alternative investments, should that be of interest to you. By the way, one of the reasons alternatives are so popular these days is because a lot of folks have concluded the market is way overvalued, and they don't want to participate in the next market reversal. Alternatives are not correlated with the stock market, which means they don't behave in the same manner. So when the markets crash, you won't be surprised to learn alternatives don't necessarily behave the same way. I realize we've covered a lot of ground today and hope this information has been helpful to you. If you'd care to set up a no-cost review of your circumstances and review some planning ideas from my office, please don't hesitate to schedule a web conference on my calendar at this link and click on the meeting that says Exclusive Webinar Offer. It'll look like this in the lower left. Once you click there, it'll take you to a calendar page where you'll be asked to select a date to get together. And then you'll be taken to a page where you can select a time. And finally, you'll be taken to a page where you'll be asked to fill in your name, email, and phone number. We can review RMDs, asset allocation, annuities, Roth conversions, as well as any other topic not discussed today, like tax reduction strategies. Whatever is the biggest priority for you. It's a no-cost get-together, since my purpose is to try to develop new relationships and offer insights that may not have crossed your desk yet. Please take a moment to read our disclaimer. You can pause the video at any time. And finally, I want to say thank you to everyone who watched today's presentation. You've done something today most people are not doing, taking greater control of your retirement by educating yourselves. Thank you again for joining me. This is Ed Papier with Amadeus Wealth Alternatives, signing off.